Well, in terms of what's happened over the last 6 or 12 months, it's been pretty much what we've been focused on since we launched the trust back in August 2017, which is creating additional homes for local authorities so that they can move vulnerable people with care and support needs out of institutional care settings and provide them with their own independent, community-based home. And to that end, we have invested into 44 new properties over the course of the last 12 months, which provide over 300 homes to vulnerable adults with care and support needs. As well as being focused on increasing the size of the portfolio, we've also been focused on investing into our existing housing stock. And to that end, we announced midway through last year that we were going to invest £3.4 million into bringing all of our existing properties up to a minimum energy performance certificate rating of C. So that is a retrofit program which will take the next 3 years. We'll do that by 2025, and that will be 5 years ahead of the regulatory requirement to have our portfolio to that standard by 2030. We're doing this because we want to be proactive, and of course we want to increase the carbon efficiency of the portfolio of properties that we own. Over the last 6 to 12 months, we also increased the number of counterparties that we work with. So we entered into leases with 4 new counterparties, meaning that we now have an increasingly diversified portfolio of housing managers, which totals 24. Those businesses are responsible for managing our portfolio of properties, which are located up and down the UK, principally in England, but with some properties in Scotland and in Wales. There are now 448 properties in total that provide over 3,000 homes. Those properties are leased to our lessees on long-term leases, and the weighted average unexpired lease term is still over 25 years at 26.2 years. The value of our portfolio increased by about 70 million last year, so the investment value is now at 642 million at the end of December. That was driven predominantly by the fact that we acquired additional properties over the course of the last 12 months. So that's the impact of those 44 properties that I spoke about at the beginning of the response to this question. Finally, as you expect, the annualised rental income increased by a corresponding amount and was £35.8 million by the end of 2021. So the Trust has had another strong year in terms of financial performance. We paid out a dividend of 5.2 pence, which was another inflation-linked dividend, inflated off the back of the February CPI figure, which was 0.4%, because of course in the first half of last year, 2021, we found ourselves in a low inflationary environment. And what that means is that the Trust has met its dividend targets for the 5 years that it's paid out a dividend, all of which has been in keeping with the policy it set out at IPO, which was to pay a progressive dividend, which would increase in line with inflation. Now, dividend cover was 0.99 times on a look-through basis at the end of last year, so in December 2021, and we expect the dividend to be fully covered in Q2 of this year. Now, midway through last year, we took a really important decision, and that was to refinance all of the Trust's floating rate debt with long-term fixed price debt. So the Trust had drawn down £130 million under its revolving credit facility. Critically, that debt was priced at a margin over, well, previously 3-month LIBOR and then latterly 3-month SONIA. And what we wanted to do is mitigate the risk of rising interest rates by refinancing that debt. We drew down £195 million of debt from MetLife and Barings, such that now, critically, all of the drawn debt of the fund is long-term, so with a tenure of over 10 years, and fixed price. So the weighted debt maturity is 11.6 years, and the average cost of debt is 2.74%, and that cost is fixed. And so when you couple that with the fact that all of the fund's leases are linked to inflation, predominantly CPI, we feel the Trust offers really good protection against two of the things that investors are most worried about at the moment, namely rising inflation and a corresponding increase in interest rates. I'd love to talk about two of the properties within our portfolio, and they are Cornmill House and Brunswick Gardens. These are both new build properties. Cornmill Houses are located in Leeds and Brunswick Gardens just outside of Newcastle. And both of these properties provide 16 individual adapted flats to vulnerable adults with care and support needs. And often they've allowed those individuals to move out of long-stay hospitals or registered care facilities, or in some instances family care environments, and live independently for the first time within a local community, whilst also critically receiving the care and support that they rely on. And we think it's so important when you own specialist supported housing to obviously visit and inspect the properties, but not just from a point of view of the physical asset, but also to check in with the individuals to see if these investments, if these homes are having the impacts on their lives that you hope they would. And that's exactly what we've done with Cornmill House and Brunswick Gardens. You can see there are case studies of these properties on our website. And we've gone up and we've sat down and we've talked to people living in these homes to get their feedback on what the impact that these properties have had on their lives. And there's common themes. There's themes of independence. There's themes of having a place to call home. Well, boringly, I guess, we want to focus on doing what we've always done, which is providing additional homes to local authorities so they can reduce their social housing waiting list and provide better accommodation to vulnerable people with care and support needs within their communities. And interestingly, there was a white paper on social care published by the government at the back end of last year. And if you look in this white paper, you'll see that the government forecasts that 1.7 million more people are expected to be reliant on social care over the next 15 years. And the impact that the government estimates this will have on demand for specialist supported housing is that there will be a need for 125,000 additional units by 2030. And that's why we're so focused on ensuring that private capital continues to develop and adapt more of these homes to make more specialist supported housing available to local authorities. In addition to that, we put out an announcement in April about wanting to broaden our investment mandate, to change our investment policy so that we can invest into more flexible leases. We're conscious that we are a participant in an evolving sector, and we want to continue to work with the best RPs in these sectors, the best registered providers in these sector, and we want to continue to secure best-in-class properties for our investors. In order to do that, we feel we need to broaden our mandate and slightly change the lease structure into which we enter with our registered providers.